Thank you so much. Good afternoon, everybody. Good morning, good evening, depending on where you're joining us from. Can you just confirm that I'm audible? Sunil, can you
Yep,
hear me?
yep, yep.
Perfect.
Clearly,
Okay.
clearly.
All right. So great to be here. My name is Oyindolapo Olusesi. I'm going to be hosting this wonderful session today. I work with the legal team here at Kora, and it's very exciting to be here. So what I'm going to do is just do a brief introduction about the why we are here today, the events that we're here for. Then I'll let my speakers just do a brief introduction of themselves as well before we go straight into the questions. All right. So one very interesting thing about startuping is everybody at one point, either at the beginning, in the middle, at a later stage, you definitely need to raise funds or you need some form of external funding support. Oh, perfect. Great. So you need some form of external funding support. We know that what typically happens is nice to have you, Maya. Welcome. So what typically happens is founders, looking to have to raise the initial funds either from friends and families or from their own pockets. But at some point, you have to get outside. Specifically when you are approaching the point where you have a product, or depending on the complexity of what you are trying to do, you need to raise some funds. And the goal of this event, what we're really trying to achieve, is to see how we can prepare founders through, obviously, I mean, all of the panelists here are people, seasoned investors who are really, primed for this kind of a conversation. And I believe that what our audience will be really looking to get out of this today, and I believe they will be getting out of this today, is to understand the specifics of fundraising. And I'm sure that we have, founders or people from startups at different levels in their startup journey. So I'm sure it's going to be an exciting one. We have such a very wonderful set of panelists. So, like I said earlier, I'll just give each panelist a moment to just introduce themselves. So I'll start with Sunil. Sunil, please.
All right. Well, nice to meet you all. So I'm Sunil Sharma. I live in Toronto, Canada. So I'm in downtown Toronto near our big university. And I've had been investing out of Techstars for about seven years, I guess, or so. I ran 9 batches, so an accelerator fund, 9 batches here. We paused the Techstars last year, but there is some effort for me to bring it back. So I'm in the process of trying to do that right now on a slightly adjusted model. But what I think brought me to this panel is I had the idea, even though I'm all the way in Canada, to sort of become very curious about the rise of the African innovation landscape and the opportunity to support entrepreneurs in Africa. I'll start by saying I don't have any personal background or experience with Africa whatsoever. It's just something that intuitively made some sense to me. I wanted to learn more, and it ended up leading to 40 investments made from the Toronto Fund directly into the continent. And the majority of the companies happen to be based in Nigeria. And the first investment of the 40 is this one. So this is why it's very exciting to be here, that Kora invited me. This was the first deal out of the 40 that I made. And I think if it wasn't for Kora, this would have not sort of taken the natural path that it did. So I'm very grateful and excited. And I love that explainer, that intro video that you just played, Oyen, because it was very, I love to see it. And it's quite a pivot from what the company was back at the very beginning when I first met.
Absolutely. Absolutely. Thank you so much, Sunil. And I like a particular part of your introduction there about Kora. We typically blaze a trail, and that's what we do here at Kora. Happy to have you here, Sunil. Anil, please go. Are you muted? Yeah, I can't hear you, Anil. It says no, it's the same. No, we can't hear you.
How about now?
Yeah, we can hear you now.
It was weird. Okay, great. So saying thanks for having me. in personally, I mean, in my context, I've spent 2 decades building businesses in Nigeria, from FMCG to renewable energy to tech, and I've seen firsthand here how the talent can solve problems that the rest of the world just hasn't even begun to tackle. Right, so. Too often that talent is held back, not because of the ideas not being good enough, but because the right kind of early support just doesn't exist. So as a partner at Antler, that's what we have set out to change when we launched in Africa. It is to back exceptional individuals from inception, sometimes before they even have a company, just with capital, community, and support to turn big ideas into scalable businesses. Our thesis is simple but deliberate. Africa is the world's largest growth market, and its unique challenges are opportunities in disguise. So we want to focus both on high growth tech and tech-like innovative solutions, which focus on the real economy, whether or not. So the way that I go explaining that second part is, if there's a poultry farmer that has figured out how to get a chicken to lay 2 eggs instead of 1, we'll invest. So we're looking for businesses that truly impact the African landscape, and we're happy to support it in that.
Thank you so much for that, Anil. Thank you. Maya, do you want to go ahead? So, thank you.
Sure. My name is Maya. I'm the founder of Ingressive Capital. We have 2 venture funds under management, as a nonprofit that's training hundreds of thousands of African youth in technical skills. I've been at this for about a decade. And we have, it's incredible that, Sunil, that you have done 40 investments, because our total fund is about 60. And so, yeah, just the incredible volume, the sheer volume of African investments you guys have done at Techstars is so impressive. Yeah, so we've done about 60 investments. Our first fund was 26 investments. We've had 4 exits from the vehicle, and a 5th company is going to publicly list this year. And so that's been pretty exciting. Our portfolios are focused on profitability. So fundraising is great. Yeah, happy to talk about it, but that's not what I'm recommending 90% of my companies to do. And that's actually not what they want to do at this time, given just the ROI of investing time in trying to raise from investors versus optimizing financials to build profitable high growth or profitable businesses that can scale from the revenue generated from customers, and then puts the founders in even better of a position, given this very clearly buyer's market, to get the valuation that is reasonable for their businesses. That's really the path that we are on right now. So yes, happy to talk about fundraising, happy to talk about my experience raising for both of Ingressive's vehicles, the nonprofit, doing syndicates for our portfolio companies and helping them generally raise. But right now, the name of the game is building sustainable financials.
Absolutely. The end of the game is building sustainable financials. All right, thank you so much. So I'm just going to get right to my very first question, and this is just something to get us started, because I think it's for some. I'm sure. I'm almost 100% sure that nobody is hearing these names here at the panel for the first time, but some people, may not really be familiar with the funds or the organizations that we work with. So I'm just going to ask, just very quickly, if you could just share a brief origin story of your fund, and the unique problem that you set out to solve in the investment landscape. Very quickly, I'll start with you, Anil.
So Antler is a global VC firm that focuses on inception ideas. If you are a high-performing individual with deep domain expertise, you want to build a business, but you don't have the necessary support or the resources or the know-how of how to build a venture scalable business, join our residency. We work with you hand in hand for 2 months, and if you are able to provide POC within that period of time, we are the first check in. So we're almost an institutionalized friends and family round, because that's how early we come in. We come in at the earliest stages when you're still kind of ideating and not sure, whether you can actually go out and raise funds.
I'm sure this is something that would excite a lot of the people in the audience, because the most difficult time is getting somebody to buy into your idea, especially at the very early stage. So thanks for that, Anil. Sunil?
Okay, first of all, I'll speak a little bit in my personal capacity in the past tense, because I'll talk about how Techstars operates. I'm still involved, but I'm no longer running the accelerator here in Canada at this moment. But there are similarities with Antler. These are batch-based accelerators, early stage. The investment capital is now $220,000 US for a percentage of some percentage of equity, usually 7 or 8%. It seems to work out at. Usually common shares, so we're like kind of aligned with the founders. It's a program, 3 months, a lot of mentorship, a lot of access to thought leaders and customers. It's very global. So one thing about Techstars, and I think as Antler is, I mean, I know it because there's one here in Toronto with me, a very active accelerator, is they're spread out around the world, and founders have the ability to apply and sort of express interest into an accelerator in some geography. It doesn't have to be their own geography. So obviously, I'm sitting here very far away from the continent of Africa, but found personally very interested in investing there. So it started to lead to deal flow. It started to lead to some applications and co-investment. And Canada, is a great distance physically, but in terms of business alignment, sector focus, things like AI and talent and payments and fintech, a lot of opportunity to collaborate. And in some ways, I think about this as the global diaspora. So we have African people, not just living in Africa, but around the world, in some countries making up some of the largest influx of migrants and aspirational immigrants. So that leads to a connection point to invest as an accelerator far from home. So there might be an advantage to having relationships in the North American market, and perhaps an incorporation of your business, and perhaps some support for visas. And so it's all about what does that accelerator signal to the entrepreneur, and is there a match? And if we can help, I'm sure Anil will also agree, we like to support companies where we ourselves think that we might be able to contribute something beyond just a small amount of capital, money. That's network and support for the founders. So that's how we work at Techstars.
Thank you.
I think you just muted yourself, Oyin.
I thought I was muted. Yeah, Maya, thank you so much, Sunil. Maya, please. Maya, you're muted.
You're muted, Maya.
Okay. And this is on the strategy of Ingressive generally, and then how we went about founding, correct?
Yes, please. Yeah.
Yeah, I would say the strategy of Ingressive is we're just generally high level focused on 3 things. We started as a generalist fund, really because the tech ecosystem was so nascent. It was really about taking advantage of the burgeoning broad technology ecosystem, and there weren't enough. I mean, there were, of course, a number of and a concentration in financial services and telecommunications tangential, but I'd say just every other space was emerging, and about half of it we were seeing was really throwing something at the wall and seeing what would stick. And so I think generally when launching a business in a new technology ecosystem, having a more generalist strategy is and can be effective. At least it was for us. And the performance of Fund One is supporting that as well. But now that we've been able to reflect on what we did with those 26 companies in Fund One and all the SPVs that we did, it really boiled down to 3 industries. Really was the concentration of our alpha in Fund One, and that's financial services, which everyone knows, like fintech and fintech tangential. That's trade tech, so platforms that facilitate commerce across Africa. And then that is thirdly well-being. So that's healthcare and this, this burgeoning tech-enabled youth population or youth that are domestically or based domestically, but being employed internationally and working in the technology sector, and then earning foreign exchange, but from the continent, now have disposable income and ability to spend on well-being more generally and sort of lifestyle solutions. And so that's it's not a massive demographic as of now, but it's very quickly growing, and it's something that's really interesting to us. So I'd say generally those are the three as far as where we're actively investing: Nigeria, Kenya, Egypt, Morocco, and depending on the economic stability of Ghana, we look there as well. This new administration seems to have their stuff in order, so we're actively beginning to look at Ghana once again.
Thank you so much, and hopefully Ghana remains economically stable. Thank you. So I'm just going to now move to say a more interesting part of the, or maybe let me say, into the meat of the conversation, and and this is something that I personally find very very common amongst founders. Trying to, especially when you are at the stage where you are trying to convince somebody else to part with their money and give you their money, which is essentially what is happening, the exchange of value, at a point when you can't really determine for a fact what value the other person is going to get in return for the money that they are giving to you. It's all just postulations and theories and all of that. So we've heard this question a number of times, that investors are really looking for not really looking to invest in the person. They are, not really investing in the business, they're investing in the person. And then sometimes you also hear that, oh, there's a difference between a venture backable business and a great business. So I'd really like to ask what your thoughts are, and I'll be directing this at Maya. What do you think is the difference between a great business and a venture backable business? You're muted. Hi, Maya, you're muted.
Okay. We have actually been seeing both of them, even at our investment committee, like having this existential question of, even from a portfolio diversification play, is do we want some solid businesses that are not necessarily venture backable, but have very sustainable financials and sort of very predictable revenue generation, and just like an increased likelihood for and some sort of outcome or liquidity event, though it's not going to be sort of the multiples we're looking at in VC, versus those pie in the sky, billion-dollar potential opportunities only. And of course, we are an early stage venture capital fund investing in high growth technology, and so the latter is where we landed on. But this really truly has been an existential question we've continued to ask ourselves, even from a general portfolio diversification play, looking at the African ecosystem. And so to answer your question, good versus great, or not even good versus great, because there are great businesses that are just not venture capital funds. And this may be a hot take, but generally we see hardware companies in Africa as not being venture backable businesses, as more private equity play. Not that they don't deserve financing and not that they should be stayed away from. They do make, great businesses. Interesting things have come from the space. But this is something that we've had to even secondly reflect on recently, is justifying. So there's the piece of justifying the business models that expose the company to the wrong side of currency arbitrage, given what's happening with devaluation across the continent. That's an aside. But the businesses that need some sort of capital in order to, like some sort of debt in order to scale, like, are those really venture backable businesses? So I'm going off on a tangent. Your main question was the difference between the two. And I'd say for us, we really are focused on pre-seed companies, so 5 million post-money valuation and below, just the early stage companies on the continent, because we think that companies there and below really can realize the venture capital type returns, the MOIC that we're looking for. And those sectors tend to be as close to software as we can possibly get building something on the continent. So minimizing offline, minimizing logistics, minimizing sort of multiple parties receiving revenue before it gets into the bank accounts of said company. I'll stop there and let the other speak.
Thank you. That was a very specific one, and I'm sure that it hits me a little bit hard when the specifics of hardware companies are I'm wondering what is happening to all of the startups going on in the minds of the startups trying to build hardware for Africa. But I think it makes sense from the angle that you painted the story, and very clear as well. So Neil, I'm going to come to you, but I'm going to add a layer to it. And I'm going to ask, to just what are the things that a founder should also be considering? Again, supposing I am not a hardware company, but I still need to know if my business is venture backable. What are the things I need to bear in mind, and what should I also be thinking about when I'm thinking, okay, should I bootstrap this business, or should I go for an equity or a debt investment?
Sure. And as Maya was answering, I was thinking, very much the same thing, that like at an early stage tech company, it's easy for an investor or an accelerator to get excited and believe that there's a business here. Like what we're seeing, and with this founder and this team of founders, there's definitely a high potential that you're going to build a business that can make money and can be, can grow. But what we're also asking is, where would that business go in 5 years or 10 years? Like, what would the outcome be in terms of an exit? Because ultimately we have to return the money that we're investing to our investors, to the limited partners. And, I've been doing this for so many years that I've sort of seen this many, many times, where the companies that we invested in are, they're doing well, they're growing. These are great businesses, but what's going to happen in the future to return the capital? And would that business have just been, would it have just been fairer for everybody if that was just a bootstrap company that grows and it sort of fits the cadence of the entrepreneur and the team, that, we're making a good income, we're employing people, and we're have a good camaraderie at work, and this is fine, just let it keep going, because exits may not really either be in front of us, or we may not want that. And then the investors kind of have to go along with this for a very, very long time. And that not only does that cause some problems with your fund, but it also can, be an obstacle in doing more of this, raising more money, because those same investors are kind of waiting for, you say that I read about this company, I go online, and even though it's all the way, say, in Africa, and it seems to be doing well, there's lots of employees on LinkedIn, but where are we going to get paid out? And that's something to consider at the beginning, but it's hard to predict that. So it kind of becomes, you kind of are acting like you're psychoanalyzing the mindset of the founders. Like where do you see yourself in the future, and how many years into the future? And then it's kind of like a gut feel, and that's the job of early stage investors. You invest, and you kind of support, and you see where this goes, and hopefully the big outcomes outweigh the companies that kind of languished and eventually stopped, or that didn't make it, that had to shut down.
Thank you, Sunil. So I hear from that exit is very important for the founder as well to also think about from the perspective of the investor at the beginning. So you're approaching the investor, and you know that there has to be something that is in it for the both of them. So Anil, I'm going to come to you. And again, just the same question, but I want to add another layer to it. And I'm here thinking, what are the things you would, again, Sunil had mentioned that investors are psychologists of some sort, because you are psychoanalyzing the founder, trying to be sure, is this person investable? But for you, what are the signals that you look out for when you are trying to determine whether you want to invest in this founder or
not? So I'm going to first start with the first part of the question, which is, what is a great business versus a venture backable business, in my opinion, right? A great business is one that is profitable, sustainable, and possibly life-changing for the founder and their community. It may grow steadily year after year and create, value for that particular setup. A venture backable company, though, plays with different set of rules. It has to solve a huge problem in a huge market, and should be able to scale at speed. So a 10x growth potential is kind of where the mind is when you're thinking about a venture backable business. So the way that I look at it is that all venture backable companies are great businesses, but not all great businesses should take venture capital. I'm not saying that they're not, like, that's the distinction in my head. Having said that, Antler, I mean, we're supposed to take a slightly different position on this. Africa has African problems, and not everything can be solved with tech. Some of it are infrastructural issues. Some of it are fundamental, issues that can be resolved in a different way. So to kind of plug one of our portfolio companies is Uncover. It's a skincare brand that has huge inventory requirements and typically would not be considered by venture capital. But we back them out of our program, and they have done phenomenally well in the space. And we're very eager to kind of back more companies that can simply exhibit. So we're not necessarily chasing unicorn statuses. What we're chasing for is a founder that understands that, we have to 10x this money, and that's, if we have enough companies that can sustainably grow and give a return back on the investment, even in terms of dividends, we're perfectly fine. So we've kind of like, in our investment plan, we even have like a debt portfolio where we can provide some debt relief to companies over a period of time if we feel that's what they require to grow. So that's the first part of the question. The second part is what signals. At the stage that we come in, it's all about the founder. It really is at this point where, it's very early to kind of imagine what this business is going to look like in 5 years, what the regulatory, statutory, situation may be like. We're looking for people with domain expertise that understand that startups also are a business, and they have that very business-like mindset from day one. They're frugal with their spending. Their mindset is not about the next conference in San Francisco, but it's more like, oh, let me go to Abu Laiba market and try and peddle my wares. So I think that these I wish there was one archetype that we could say was one size fits all, but it's really when you spend enough time with the founders, which we do as part of our residency, you get a sense of like, is this guy an outlier? And that's who we back.
Thank you. And I just want to take you up on something that you said earlier, just to expand a bit on it. So I don't know if it was arbitrary or it was intentional, but you mentioned 10x. So I'm wondering if I were speaking to you as a founder, am I telling you that, hey Anil, don't worry, I'm going to return, you're going to make 10x of this, and that would sound good to you? Is that like a destination, or is just a
Hey, Owen, if I had a penny for every time someone told me they're gonna 10x my money, I wouldn't need to do this anymore. Like, I'm sure it's for every one of us, right? I don't think that that's the standard by which we make these decisions. But to make a point, I was just basically using it as a metric that if I can see a financial pathway, not what they say, but what they do. If I can see a financial pathway for a 10x return or a 10x growth, basically on investment, I would probably take that up.
Okay, thank you, Sunil. So thank you, Anil, rather. So I'm going to throw this next question to Sunil and Anil, but Anil, let me just stay with you since we're already on that trajectory. And you mentioned something, particularly Abu Legba, that you mentioned. I used to live in Abu Legba, so I was very excited to know that you know Abu Legba in Lagos. Yeah, so you mentioned something, and you were saying that you want to see if this founder is an outlier. It seems to me like there are characteristics of people who would come across as outliers. I don't think it's something, I'm not sure. Again, this is a question I'm just trying to find out. Is it about the way they speak? Is it about what they say? Or is it about their obsession with the what they are trying to build? And then again, what is the most important part? Is it the obsession with the product, or obsession with giving the next or a huge returns to the investor? So what is it for you? What should a founder be? What would you really be looking out for if you were, assessing a founder in that regard?
So an investable idea, in my opinion, has like a couple of components, right? It has a large and growing market, a scalable business model, and a team that can execute fast and adapt. That's the way that I think of an opportunity. When we're talking about founders, what I like about a founder, and again, there's not one size fits all. It's not one answer that works across the spectrum. But one thing that I look for is how fixated are you with the idea, and how flexible are you with how you're going to get there. The combination of that is what is extremely interesting to me. So whatever your problem statement is, whatever your experience is to solve that particular problem, the market size being large, because to quote Mike Tyson, everybody has a plan till you get punched in the face, right? So it's a great quote. It's a great quote. I love it, and that's what happens in startup life. Like the market's gonna punch you in the face. Like there's nobody smarter than the market. So you have to have that flexibility of saying, okay, this is how I want to get there. This didn't work. Very quickly adapt to something else. Without having to kind of bring your ego into it and wanting to prove a point over and over again. That's what stands out for me.
Thank you. So flexibility, adaptability as well. Yeah, Sunil, good.
Sure. I think the integrity and the tenacity of the entrepreneurs, of the founders, like what's driving them. You try to feel that, and then so Anil is an expert. He's African. He's an expert on the market. So there's things that will align, and obviously Maya as well. Obviously will align. They'll see things. They'll understand the market. When you're far away, I think you rely more on the person and sort of imagining like where can they take this business? How convicted are they? What's driving them? What have they done before? What are their limitations? How's their team constructed? And like what and how can they explain this opportunity to people that don't really see this opportunity in front of them every day? So their ability to communicate, over communicate, simplify, and get that kind of excitement in someone else that just believes that this is a business that will happen and should happen. Someone's going to do it, and it'll be this team. And then the other thing to add is, because investing in startups is often like a team sport, like it's syndication. We invest with other people. So who else believes in this? And tell me why they're a believer, and how did they demonstrate their belief? Like they were a small angel investor, or somehow an early customer, or a advisory board member. And then let me talk to those people, and then together, we can sort of understand, like, yeah, there's something about this team and this founder that I'm also feeling it, and I don't really know as much about the market. So then, well, what value can we bring? Is there something? Does North America matter to this company in the future, or does the talent that we can assemble for them, or the AI models that we can sort of support, like does it matter? Is there a fit? And then it's how fast can you go? Because these companies, the good ones are going to get funded, and often the people in the know, like your CEO at Kora is Dixon is an incredibly highly regarded business leader in the continent. Other people that I read about or I've met a few times, like the GBs or the E's, these people, if they're they see everything too. And so if there's this kind of groupthink, and it de-risks. And it makes it basically just presents an opportunity. And if you can be helpful, and let's go, let's invest a little bit of money and give as much help as you can into the team, and watch what happens. And you won't know for a long time, but at least it'll be enjoyable along the way. And you can see the growth of companies creating hopefully lots of jobs and economic impact for different countries around the world.
Thank you, Sunil. So staying on you. One question, and I want you to give me a figure. How many bad ideas have you come across?
Well, I don't know. Bad ideas. I don't know if they're bad ideas, but things that didn't work. I think timing is the biggest factor. Like it's if you're too early in a business model, it's a great idea, but it just wasn't the right time. And then something later that's very similar or even inferior can be very successful, and it's all just about timing and mindset and investor appetite and like the trends. So I don't know about bad ideas, but just lots of ideas. Most startups, this is the fact, most startups, the vast majority will not succeed in their original goals of being a very very valuable large business. They fail, and it's not necessarily the fault of any person or team. It's just it didn't work, and it wasn't there's too much. You didn't understand your competition. You didn't the market didn't move in the direction you thought. Your team wasn't, or you didn't have the drive. It wasn't your calling. You're better off to work in a proper career, climb the corporate ladder and innovate from within enterprises. That's a great calling in life as well. Startups aren't for everyone, but so many people are launching startups, and there's ideas everywhere. It's execution. I run the Founder Institute, which is very, very active in Africa, in Abuja, and in Lagos in particular, those chapters, and I do it in Canada. And we're basically seeing thousands of founders, who are there to launch startups, and through the process, the vast majority over time will stop, but hopefully it was a good experience, and learning from it and taking those failed ideas into something else and being successful there.
Okay, thank you. So, and you answered another question I was going to ask, which is about timing, but you answered that. So let me come to my bit. So I don't know about bad ideas, but maybe timing is the issue. Quoting Sunil, but how does domain expertise, right?
Oyin,
How
you
should they
just
approach investment?
Oyin, can you hear me?
And how, particularly, how are they able to build credibility? I think
My
my
friend,
network is
cut
keeping.
out.
Can you confirm that you can get back?
I missed that.
Okay, I'm just going to take it again.
Yeah, can you
Am I
take
good?
it?
Okay, thank you. Yeah. So I was asking how a founder who has a great idea, but doesn't have domain expertise, how is such a founder able to build credibility, especially when it is time to go and raise funds?
I mean, it's all about execution. So I don't really, it's not terribly important to me whether a founder has built a business or has extensive experience in this space if they have the metrics and the traction to prove otherwise. What all that matters, everyone has great ideas, everyone can talk a good game, everyone can do research on whatever sector that they're most interested in, everyone can be an employee. Well, a lot of people can be employees working under a vision built by and executed by and driven by, steered by somebody else. But when it comes down to it, really all that matters is execution and metrics and progress and traction. And so if you're an early stage founder from a no-name region in some obscure country, but you're building something exceptional and you have 30% month-over-month growth and you have solid financials and you'll be profitable within your first 12 to 24 months of founding, and you've been able to retain an interesting team around you, it doesn't matter. So for me, it is exclusively about execution.
Thank you. Anil, do you want to add something to that?
Yeah, I mean, Maya's view is very valid, and obviously, once the company has kind of gotten to that point, the metrics speak for themselves, right? For us, it's slightly different because we come in so early that you really have to leverage on the person that you're kind of working with before there are proven metrics. And in that case, one of the key components for us is domain expertise, because you could spend the next 2 years burning through the cash trying to figure out a problem that you could have learned by the virtue of your experience, working under someone or working alongside someone, and that could save you a lot of heartache. That could save you a lot of, having to kind of bang your head at a brick wall. And there's value in learning at somebody else's dime, so to speak, as opposed to your own, which is the investment that you land. It just helps accelerate this faster, and that's my view. So yes, absolutely, our intention is to get founders that have a domain expertise. We've actually seen like an 83% success rate for founders that have domain expertise, at least in our cohorts globally, versus the ones that don't. Only because of as early as we come in, and that translates to metrics and of course your ability to deliver. which at a seed level becomes attractive to subsequent investors.
Yeah.
On your,
What I hear,
yeah, sorry,
yeah,
you're muted.
yeah. Thank you. So what I hear from what Maya said and what Anila said as well is execution still. So you need to be able to show that you have the domain expertise, either by most likely by showing some form of a level of execution. So I'm going to come back to you, Maya, before I move to pitch deck. What's how much execution is enough at this point, right? So is it enough for me to say, hey, see, I'm a lawyer who has learned how to program and I've been able to build the back end of this product that we're trying to launch? Is that enough? Or does it how much execution is enough execution at this point? You're muted.
How much execution is enough execution at the early stage? I mean, for us, it does depend a little bit on the sector. But really, when I'm talking about execution, when I'm talking about traction, I'm not saying I need to see that, tens of thousands or thousands of dollars or millions or billions of naira or whatever local currency. What I'm saying is, I want to see that I want real practical demonstration. Also, Oyin, are you frozen? Is that just me? Is he frozen is that a
No,
painting? Has his
I think
face become a painting?
Yes, but we can hear you loud and clear. Carry on.
Oh! Okay, yeah. For me, I would say it's just showing, hey, this is such a real problem and solves it so well that people are willing to pay repeatedly, consistently, and use this product repeatedly, consistently to solve their specific problem. And this seems to be based on customer feedback. Revenue paid and in a business model that really does make sense and is scalable. This solves a real problem, and people really through this, I can deduce logically, practically, not through rose-colored glasses, that this is a growing solution and there's a big market for it. So I'm looking for data that demonstrates customers really like this enough to prioritize or to pay consistently to in a business model that financially makes sense. So that for me, depending on how much it costs to deliver the product to the customer, that's like kind of what my metric for what sort of traction I'd need to see in order to make sure it makes sense. Like for just an example, say you have an AI agents doing, or I guess AI agents because your OpEx would be low, but like say you have some combination of hardware plus, say you're making robots for enterprises to do, I don't know, labor in the facilities, and you're closing $50 a month SaaS agreements when your overhead, it costs you $10,000 a month to produce and deliver the product and delight your customers. And so the traction that I would need to see, like it versus a fintech company, an early stage fintech company that's that made $50 a month one month, and then $100 the next month, and then $200 the next, and is growing month over month. But their overhead, their OpEx, no CapEx, their OpEx is really low. And I can see it's like a high volume, low margin game versus another type of business that's really expensive to deliver the product to the end customer. I need to see a larger revenue and sort of more meaty, long-term committed client relations in order to de-risk and make that business model make sense. So again, it just comes down to what sector are they building in? How much does it cost for them to get the product in the hands of the customers and delight the customers? And does the revenue that's generating eventually down the line make sense to cover those expenses and allow the company to eventually become profitable? Because I know that Silicon Valley is back to growth at all costs in the AI space, but we in Africa, we are not. So me, I like my logical businesses.
Yeah, and I like the fact that when you were saying that, you said it in the African with the African tone. We in Africa. All right, thank you. So just to be sure, am I still? Can you still hear me? Because it seems like
Now we can,
yeah,
but you're
thank
very
you.
much frozen.
Frozen, yeah, but we can hear you.
Okay, thank you. So when I ask this, I'll just try to
All
switch
good.
my
It's a good
internet.
shot. It's not like an awkward shot. You know, sometimes you get frozen. You're making a really awkward face. You're not. It's good. It looks mysterious.
Thank you, thank you. Okay, so so my next set of questions will be for the pitch decks, right? Because most times the way you introduce yourself to your prospective investors is through your decks, right? And obviously we have a panel of investors who have exposure to Africa, but also globally as well. Right now, for an African startup that is looking to attract global investors, how should the pitch deck and the story differ? When approaching those kind of investors, right? How should the assumptions be addressed in the pitch deck? I don't know if that question is clear, and I'm directing this to Sunil.
Yeah, that's fair to ask me. Yeah, I think it's true. It probably needs to be more informational and educational for investors outside of who are off the continent. Even investors who have experience and have made investments, like sometimes their own personal background is one where they originated from Africa or lived there for a period of time, children of diplomats, or worked in NGOs previously, or born in different countries and migrated out there. There's a different perspective. But even I find, even for people with that background, things have changed so much. And the questions that are on the in your mind as you're reading a pitch deck may be ones that you can kind of anticipate and answer, and things that I've I really do think about the domestic currency in this market, like the devaluation, as Maya just said, like there's so much devaluation. Like, what does that mean? In some cases, maybe that's a good thing. Your operating costs are lower, or the currency will rebound and you'll ride it back up. Or is there risk or regulatory risk? Like what are a lot of the companies seem to be payment and fintech companies, right? That's African founders love fintechs. And so the regulatory, central banks, the compliance that the company would have done, really explain that. The licenses really explain what you have or what's on your roadmap and how you're going to get it. And then what's the, if there is a long-term reason to be taking investment from outside, from another place, like what is it why would you want that? Is it just that there is some capital there, or is this country really important as an expansion point into a new market, into Europe or North America or South America, Asia? Like, is there a plan? Is there a personal plan? That we see ourselves maybe living there at some point, or when we have families, this is a place we've always wanted to be, exposed to. Maybe that's helpful, and we can determine if that's likely, or if that's more possible through an investment from an outside investor. Or is it just validation? Like it's sort of like getting into Antler or getting into Techstars, might be seen as a real like differentiator. It's a success mark. It's like going to an elite university, and in that signals differently in certain geographies or regions, maybe more than others. And maybe if that's the case, explain that. Like, so because I can see that as being value, and then the investors often get a preferential price. They get this is maybe a less expensive deal because you're adding something important that really matters to the founders, and it's worth the 1 or 2% of discount, let's say. So just explain that, and let us feel like we can understand and be valuable to the company. Like, what can we do to help you? Relationships with other companies, with big tech companies in Silicon Valley or New York. Is that the point you want to be? You want to be talking to them, and if you have an outside investor who they know, like, this is the plan, great. I support that, but just kind of be very clear, as you can. And then we can see if that makes sense, and we can actually do that, or if I'd never be able to make those things happen, so therefore like this wouldn't, in the long run, wouldn't be valuable to the founders. So then it would be good to have clarity. So yeah, not dumb it down for us, but make it like simple and lots of examples.
Okay, thank you. That's very clear. Thank you so much, Sunil. So Anil, I'm going to ask you this. So still on the subject of pitch decks, how should a founder balance this massive 10-year vision of their business? How do they balance that with a concrete 18-month execution plan in this pitch deck? And bearing in mind, there's the theory that investors like your pitch deck to be as concise as possible, right? So you want to be able to paint this picture of your 10-year massive idea, a vision for your company, and you want to balance with it with an 18-month execution plan. How is that able to be done in the pitch deck?
So what happens a lot is there's sometimes a disconnect between the big problem and how you're going to execute. To answer your question more specifically is, show me the mountain you're going to climb in 10 years, but explain to me how you're going to take the next 3 steps. I think that's the simpler way that I can explain this. Your problem needs to be big enough that it's going to be valid in 10 years from now, or even 15 years from now. The pain point has to continue over the foreseeable future. Obviously, there are a lot of factors, AI, global situations that may not make it relevant, but as it stands today, this problem is still going to exist in 10 years. But more importantly, it's very hard to predict what that journey is going to look like. And this kind of brings me up to the previous point that I made, is you need to be stuck to the vision, but you need to be flexible on your actions. So immediately what you can predict is, okay, over the next 6 months, over the next year, these are my action points. This is what I want to do. And this is the market size that I'm going to kind of capture. This reminds me of the first deck of Airbnb. I think in that their total TAM was like $1.8 billion. That was what they envisioned, like the full total addressable market was. And their revenues for last year, I think, was like $11 billion. So even they can get it wrong. So let's not be, we need to see the big picture, but it is all about execution in the short term. For me, that is the one thing that stands out the most.
Thank you so much, and that's very helpful. So again, still, and I'm sure I'm speaking the mind of a lot of founders here looking to raise funds, and these are very investors like yourselves can be. I don't want to use the word hard to find, but of course you have to guard your space very well. Otherwise, you are receiving tens of millions of startup ideas requesting funds, every second. So this means that it could be a little bit tasking in itself, getting introductions to the investors that you would like to invest in your business. Maya, how do I, as a founder, how can I create genuine momentum, right? Or let me say, what is the most effective way to get a warm introduction in the big 2025?
I don't believe in warm introductions. They don't not that I want this. I don't want people contacting me on my personal phone line, just so that everyone is hearing that on this call. But sometimes I receive random founders sending me their WhatsApp deck or their deck on WhatsApp. And like, I don't know who they are. They're like, greetings, good afternoon, Ma. My name is da da da. I'm like, I don't know you. I don't know how you got my number, but okay, let me check this deck out. So it doesn't matter to me at all. For me, I built Ingressive, reaching out to people cold on LinkedIn, showing up in people's offices that I did not know and that I had no introduction to, and sending people DMs on social media over extended periods of time, demonstrating that I approximately knew what I was talking about, or at least was so persistent I'd figure it out anyway. So like there's a special place in my heart for people who have no connections, no relationship to me, but have figured out how to build the beginning of something very interesting. And really that's what our fund specifically focuses on, as those people who they don't need product advice, they don't need technical support, like they know how to build the thing that they're building, but they don't have connections to investors, and they may be stuck trying to sell their product to enterprise or the people, the organizations where you have to know somebody to get in. That's where we can help anyway. So that's actually our sweet spot. I would say though, you do lose credibility when you're like, we're closing in a week, you better make a decision, blah, 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 blah. So a few things that have gotten founders blacklisted from our fund, like integrity is everything to me. And I know that you don't necessarily have to be the most integrous person in order to succeed in a tech company in anywhere, and including on the African continent. But for us, integrity means a lot. So if you say something and you give your word, or you, or on the other side, if you say something knowing that it is not fully honest, that is a mark off of, depending on the level of severity, that's either a write off or a mark off. So it's better that you're honest and communicate, hey, we're just not, like, you will get so many more points and we will be so much more likely to invest if you communicate to us like, hey, we have actually had trouble raising. Either way, we're going to, stop actively fundraising at this point in time. But, we do have a lot of traction, and I want to walk you through what we do have. You'll be so much more likely to close with me as an investor than if you come, oh, this other fund is looking at us. They're in final round DD. You have 1 week to make a decision. 2 months, you come back. Nothing happened. Okay. No. So just be honest. You can generate FOMO by being like, hey, here's our target close date, and make sure it's far enough away where you're not, making this frantic, dramatic energy, where people can actually go through their reasonable process. And you don't have egg on your face when you're like, said it was a week and now it's been 6 months, still here, and then also I realized, founders are coming asking me for money, and yet they're the ones not following up. And I'm like, what are you doing? Just going to every VC, having one conversation, not doing any follow-ups? Like, sometimes I will be the one to follow up and be like, do you want to know if I want to invest or not? Or you're busy. Do you want me to call you? Like, I don't know. Sometimes I'm confused. So have an actual sales funnel process. And like, it doesn't have to be fancy. Literally have an Excel spreadsheet with the name of the VC, if you had a phone call, what the notes were, if you followed up with them. Will save you a lot of time than having 200 first meetings and getting lost in the sauce. Really spending your time prepping beforehand, researching the fund, having the phone call, and then sending follow-up emails. And sometimes I'll miss an email once or twice. I don't really like email. I'm not the best at it. And so like, founders also not taking those things personally, I think really serves in their favor. And the last thing I'll say, some investors said no to our first fund, and I was pitching them. I stayed consistent with them for up to 5 years before they wrote a check. Up to 5 years before I got a check. And sometimes it started with like a little, a small little angel check that turned into millions of dollars of investment, and them bringing in, 10 friends to invest as well. And so just because like some founders get really personalized a no. And I know it can also be how you go about the no, how an investor goes about the no, which we have to take responsibility for too. It can't just be like, nope, sucked, talk to you later. It has to be like thoughtful and engaging. But I would say don't take personally when a VC says no. Do stay in touch if it's an actual relationship you want to build, because even for the founders, I don't ever have a plans to invest in. When they are consistent and check in and maybe ask me for advice, my doors are also open. If they start to ask me, hey, Mike, can you introduce me to this, and this person? Hey, can you look at my product and give me some advice? Hey, I know you're friends with the CEO of XYZ company. We haven't been able to reach him. Would you mind helping do a warm intro and maybe joining the first call? I'm like, you're consistent. You're in my network now. Sure. So the consistency part of it is really important, and not everything converts. Very few relationships convert immediately. So giving ample time in order for that transition to happen.
Thank you so much, Maya. This is very valuable insights. I think I'm just going to ask you, Anil. So, are you team cold or team warm? Because it seems like yeah. So Maya says she's not really a fan of warm introductions, so she's okay with cold calls.
I mean, I'm cool with them, but they don't influence me one way or another.
Yeah. So I was asking you if you have the same preference.
No, I mean, obviously, it works out both ways, but I'm on Maya's side over here. A good founder, a good deck is always pique our interest. This is what we do. So, hot or cold, just make the best case possible. If the problem is big enough, if you're determined enough, we will consider. Even founders, they apply for the residency and they don't get through. But we have seen founders that actually get in through on the third attempt or the fourth attempt because the idea has evolved a little bit. The thinking has changed a little bit. and they're able to get through. So exactly like what Maya said, I'm 100% on her side. Warm, cold doesn't matter. Consistency matters, integrity matters. How people dragging you on social media is like, oh, I sent an application, you didn't even bother responding. Like we, we did. Every single application gets a response automated through the system, but it may just because it landed up in your junk, or you just gave me a generic refusal. Yeah, I'm not going to be able to give 7,000 applications a personalized feedback as to why is it that we're not going to be proceeding with this forward. But yes, to answer your question in a simple format, a good founder is a good founder, a good idea is a good idea. We're willing to work with any way that deal flow comes. It doesn't have to be hot or cold.
Thank you so much. Thank you.
No, just to add, I think some of the challenges originate from basically LinkedIn and what LinkedIn has become and how many connections you have. And remember, when you're asking for an introduction, it can create a little bit of a problem for the person you're asking, because it might mean that, I'm just connected to this person. I don't really know them, or I've been not in touch and I should have been, and now I'm a bit awkward. I make the intro. Or if you have like the three of us have very large portfolios of companies, many of those companies would also potentially be interested in that meeting, but we didn't do that for them, maybe because we weren't asked or we didn't think of it. And now another person from the outside is asking, and it becomes like, well, what should I do here? Like I'm really, firstly beholden to my portfolio companies. I'm a shareholder and, want to help them, and other people want intros, and it just becomes tricky. But like what Maya said, it's not hard. You can get to people. You have to show your own ability and find a way and be respectful but consistent, and it's just as good. I don't know if the warm intros are that valuable, to be honest. Like, what does it really mean? It can be maybe later if something's really important and it's like, and you do really know the person and you can kind of connect with them offline or text them. Maybe in that case.
Thank you, Sunil. And this is really good. It's good to know that founders whose networks are not also as large can also still get an audience if they have something really tangible, something really valuable to sell to the investors. So Sunil, I'm going to stay with you. Now we've got past the stage of the introductions and we've been able to get the investors to send us their term sheets. So how do you advise a founder to handle the case of competing term sheets?
Well, if they're genuinely competing term sheets, that's great. Founders then need to think. Maybe one idea is you kind of try to raise more money than you originally thought to. It's often a good plan. Or who do you want to have board calls with or regular calls? What people do you think are more in line with what you do and believe in you and have the style and aren't gonna maybe cause too much additional work that you feel like you won't be able to live up to as you build your company. Geography matters, network matters, track record. So if you have competing term sheets, it's just be fair and honest with your investors, and there's always other investments for the investors to make as well. So it's a nice problem to have, I guess. Yeah.
Thank you. Maya, do you want to add something to that? Okay, thank you. All right, so we're getting to the latter part now. Now we've been able to get to the point where we've got our term sheets, everything is available, and I just want to ask, beyond the valuation, what is an important clause in the term sheets that you wish founders would pay more attention to? Right. So, what is one key thing in the term sheet that you wish the founders paid more attention to, Maya?
Well, there are a few, and I think founders, especially at the very beginning, before they're probably even hearing, like before they would even be invited to something like this, and get access to this knowledge, they're getting offered things like liquidation preferences, not being offered, like term sheets, things like liquidation preferences are being included into their term sheets or side letters or what have you, as well as exposing themselves to too much dilution, such that, like if you only own 1% of a company valued at $1 billion, you only make what, $10 million? Dedicate I mean, that's still big money. Don't get me wrong. That's still, I would like, please, if you want to give me $10 million, it's okay. But really, the people don't recognize how much dilution prevents founders from receiving money, ownership that converts to cash at an exit. And so one thing I really, we try to get really clear to founders is, and as we're moving more into the AI and sort of pure software play businesses or increasing software play businesses, OpEx is going down, founders teams are smaller, more lean, et cetera. And so the need to raise these huge rounds is decreasing as we're sort of moving away from everything is hardware. I do think it's still hardware has a place, just not in my house. I think that I think that founders really need to pay attention to dilution from the beginning phase, and then be aware of, map out, okay, this is how much burn we're going to have at this point in time. This is how much our financials, our expenses are going to be. This is how much revenue we're going to generate. And so I'm going to need to approximately have mapped this out. Of course, this is all wrong, and this is never going to be. It's never going to be exactly like this when it actually comes to execution. But having a general idea of, I need to raise once at the pre-seed, I need to raise next at the post-seed at this valuation, giving away this much of my company. I need to, at Series A, approximately give away this much of my business based on others who raise in the fintech space and have their Series A. They generally give between 15 and 20%. Then, one more time before exit. Just think about it so that you can know between you and your co-founders really how much ownership you're going to have at the end. Because if you're still required 10 years in, you've missed all, you have a family, you have kids, your parents are aging, and you don't have time to go to any family events. You don't have time to go to any of your kids' things because you have to work 24/7 and you're still up till 4 a.m. every night. And it's been a decade. Are you really going to be motivated if you only have 0.5% of your business? If you were not thoughtful about maintaining ownership and maximizing return for yourself. So one thing to think about, but then on the other side, not getting so dramatic with that you miss out on good investors or on solid and strategic investors. And so I think it's also very important that founders really look at their earliest stage investors as, so on one side, I look at it in two ways. One of, you're going to give me the money and get out of my hair. Don't bother me at all. Great. You want to give me a check and then go continue on with your life? Okay, that works. Me too. I have investors like that. They gave me a check. I've never heard from them again. They don't bother me. I do my business. They do their business. Great. But on the other side, if you are going to have an investor that in any way is going to be involved in your business, you need to make sure it's strategic and value add, because a lot of people have annoying investors. I know none of us are annoying investors. We're all very wonderful investors. But somewhere, in some region of the world lives annoying investors. I don't know where, but I've heard of them. Anyways, you just need to make sure that it's not the kind of investors who the only time you talk to them is when you send out your quarterly financials or your monthly updates. And they're like, why haven't you done more? What do you think? Just the interrogation type of investors, not the ones who are there to support and add value. So really at the beginning, it is a way of getting to know on both sides. And that's why I also say, don't go when you have a week left to do your fundraise. Go when you have 6 months and have enough time for a few conversations, because it is really, truly courting on both sides. You have something interesting. You have something that's worth investing in. Make sure that the other person is the right strategic partner for you.
Thank you so much for that, Maya. I'm sure I'm going to give Sunil and Anil as well the opportunity to answer this question, because I think everybody would have. So, Sunil, you can go ahead.
Okay, quickly, I agree with that. One other thing I think about sometimes is the pro rata that the investors have to continue to invest, and what type of investor do you have? So for instance, there are many early stage investors like accelerators that aren't built to do follow-on investing. They don't have the capital to do it. It's not the model, but there might be pro rata. And then if they're not using that pro rata, then that could create a signal to other investors that why isn't this your earliest investor? Why aren't they, re-upping and continuing to invest? So that just becomes like a conversation that you may need to have. You may need to then even have your accelerator investor, or if that's what it was, have a phone call with investors, explain just isn't that we wouldn't want to, or that the managing director of that particular accelerator personally doesn't want to. It's just the capital isn't there, or the model doesn't work like that, or it's a very small amount of the pro rata that can be used on like a formula basis. So just be aware of that. It's not a problem you'll think of early, and it shouldn't be a problem later either, but it's something to know just because signal value can matter with follow-on investors who may not know how these accelerators work.
Thank you so much, Sunil. Anil.
I feel like I'm going to get chased by saying this, but at the stage that we come in at, I'll preface that with my little disclaimer. Be wary of board control and decision rights at the earliest stages, because at the earliest stages, you want to be able to move really, really fast, and you want to be efficient in terms of making decisions unilaterally, just based on what market pushbacks are. If you tie yourself down, I've seen some angel investors that have these ridiculous board controls that just don't make sense. A little bit of freedom in the earliest stages until you kind of get to a more structured team and support board control, and of course everything that Maya said, which is liquidation preference, anti-dilution, and what Sunil said in terms of how accelerators play into this.
Thank you. Okay, so we are approaching the end of the session, so just a few more questions and we are done. Thank you so much for your time so far, to our panelists and the audience as well. So, Maya, what is what is one question you wish founders would ask you, right, before accepting your investment? You just they ask me, but they just never ask.
Can I say which one question which I wish founders would not ask me?
Okay, that's fine.
Yeah, when we get on a call, I mean, maybe I'll think of the latter one, but this one I think will be most useful for founders. When we get on a call and you have asked me for a phone call, and we get on the call and you say, "What does Ingressive invest in? Please tell me about yourself, Maya. What do you do?" How did you? Yeah, that I'm like, you know what? How about we close this call, you go to the website, because it's not hidden. It's not on some secret page that you have to follow treasure map to find. It's literally on the first page. All of our bios, literally every company we have ever invested in, the regions we invest in, why, how, et cetera, et cetera. So take a minute. You don't have ChatGPT. There's a free version of ChatGPT. No, you could just type in real quick 30 seconds before the meeting and have the cliff notes. That's all I ask. When you come to a meeting, know who you're having a conversation with and have done the base level of research to know why your company is not relevant. And don't take up my time if your company is not relevant. Don't take up your own time if your company is not relevant. The other thing is, when a company, like, we clearly invest, there are amazing funds that invest in MVP, like Antler, like what Anil was saying, that invest in MVP, pre-traction, founders with an idea, paper napkin, et cetera. That's not my life. And the website says that's not my life. And the companies we've invested in have demonstrated that's not my life. So just doing that base level of research before getting on the call, and not then being like, "Hey, do you invest in?" I'm like, you know how many videos that I've posted online saying that I don't do that? And you haven't done any of that research. It's not my problem. Yeah. So there's that. And then I would say for questions that I would like asked, or that a founder would ask me, it's always so impressive to me when a founder comes on having done the research, because each interaction that you have, and then maybe asking me a question related to it. Every interaction that you have, I say this time and time and time again, but I think it's necessary to repeat. Every interaction that you have is a data point on your ability to execute as a founder. You're talking to me about your after school activities. You're talking to me about family. You get on the call and you're 2 minutes late, or you're 5 minutes early, or however, every single thing that you do is a data point on your ability to execute as a founder. And recognizing that the way that you send emails, how long you wait to send them, how comprehensive they are, how short or long they are, shows things, not just you completing a task, but how you think about things and how thoughtful you are, your means of execution, et cetera, et cetera. So just recognizing every interaction that we have is a data point.
Thank you so much for that, Maya. Sunil.
Oh, I don't, yeah, that's interesting. I don't know, questions I'd like to be asked. I'm not sure. I think what Maya said about just if you do some homework and you know something, maybe something from your profile, like a company that, you know, you're involved with, maybe just a conversation about that, you know, but not, I don't know, I'm not really that much into like the chit chat. It's more just brevity, clarification of the vision here and how we can be helpful. So maybe just connecting the dots, like well, this is why I think you and I need to be talking. It's because of this other previous and, you know, relationship you've had or investment or something, and then just make that part of a conversation that we can just enjoy, you know, talking to each other and collecting those data points that Maya just mentioned, and through just the art of conversation, but nothing specific.
Thank you. Anil, do you want to add something to that?
I want to start with Maya's point, because I guess that's a pet peeve for everybody in our space, right? I literally had a call this afternoon where the guy is explaining to me what the Naira is. And I like, bro, I've lived here 20 years. Like, why are you explaining me what the Naira is? So yeah, I mean, that happens in one context. But on the other side of this, one question that I actually appreciate a lot is when at the end of a pitch, a founder is aware enough to ask me this one question, which is, what part of my pitch does not resonate, or, you know, gives you concern, or what is the one question that you have thought of but you haven't asked? And it's not really the question, but it's their ability to open a door into a conversation that allows me to kind of probe a little bit more, or them to have that one last Hail Mary to make sure that I have understood, you know, what they've tried to communicate. That shows to me that you are, you know, you're coachable, that you want to hear what I think, and genuinely it matters to you, and that we can have a conversation about things that might not be very painfully obvious to me. This is the one downside with working with domain experts, is because they think that dropping big words and acronyms, you know, and talking circles around you is going to be super helpful, as opposed to just kind of dumbing it down. And I usually tell people, talk to me like I'm a 5-year-old, like explain it to me in the simplest possible terms, what it is that you're trying to do here. So yeah, for me, I mean, that always shows, and there are founders that do that, and I always appreciate it.
Thank you, Anil. Thank you. So I am going to just ask two more questions. Then I have some questions here from the comments, and then we can call it a day. So let me start with Sunil. So what sectors are you currently interested in, or what kind of pitch decks most interest you now? I know that there's a lot about AI. So how much influence does that have, or what really are the pitch decks that interest you at the moment?
Right. Okay. Well, just AI for sure, and it's about the connecting the trends and then the matching the you know, in this case, let's say the geographies. So we're in an AI hub. You know, Toronto. It's one of the places where neural networks were invented. The university I mentioned is very, very strong. There's a lot of funding for AI. A lot of national centers of excellence here. Obviously, we're tracking closely what's happening in the United States and globally in AI. And then the belief is that Africa is going to become like really relevant here. There are going to be startups and researchers and innovation and spin outs and whatnot. So that's an area where it's like a nice alignment. Because of all the fintech and payment companies that are rising in Africa that are supporting, you know, the big successful companies like Kora, or the upstarts that are doing, you know, things as like relating to supporting the diaspora, remittances and cross-border payments, and helping people save money and invest money, all the fintech. So we're, you know, we have a strong banking sector, a lot of fintechs here, and money service business licenses, and it's like a global expansion point. So it seems to be another area where it aligns, you know, fintech and payments. Talent, the rise of talent. I mean, Maya mentioned they have a nonprofit. I didn't realize that, but it's a big nonprofit. Having aggressive training talent, that's a great area. We have investments in like alt school or talent QL that are businesses trying to do that. Andela got its start. Actually, one of the was living here, and was a Canadian for a little while, and that company is has done amazing things in talent from what I've seen. So areas like that, logistics, anything that is like kind of on the rise. But I think in Africa that there's going to now become more and more interest in building startups in other areas beyond fintechs and payments. Things that relate to people's health and energy, and just other core things that are going to improve lives on a daily basis, maybe in deep techs and more the more involved technologies. And so maybe we can be useful. Again, many people come over, they master's degrees and postdoctoral degrees at universities around here or in the United States, and they came from Nigeria or Ghana or Kenya or South Africa, and they now have this global kind of background, I guess, mindset, and they really understand problems, but they're very, very brilliant people, and they studied in top schools here. And so somehow then, that's an interesting area to support the launch of a company. And maybe one of the founders is in our geography, and we can work with that team. I really like it when teams have co-founders that might be in different geographies, a CTO in Toronto and a CEO in Lagos and a COO in London or something like that. It gets to be quite interesting because I'm like, these are small companies today, but they have the the real potential to become like multinational corporations and global businesses because of the geographic office locations and the access that brings the people that are in those locations. So that's a good way I think about investing.
Thank you. What about you, Maya?
How I think about investing?
What decks are currently interesting to you at the moment?
I would say, so of course there is a place for artificial intelligence. And at first I entirely rejected it, being like, Africa's not, like I look for Africa-based solutions targeting African problems, and not Africa to be the source of globally competitive pioneering technical solutions, because one, there's just not the capital to compete with the rest of the world. Like I don't know that we have the resources right now to build a competitive OpenAI or blah, 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 one of these other ones. And I also was like, initially, there are only so many processes that can be made more efficient with AI agents. It's really a logistic infrastructural issue that we're trying to crack here. But I have realized in fraud prevention, and then also how much generally Africans do like to interact with a real person and go back and forth, and how cumbersome, time consuming, and expensive that whole process of back and forth is. And the just quality of output from the average sort of customer service representative, agent, accountant, et cetera, and how that can be enhanced through artificial intelligence. I do think that there are sectors where it makes sense. I don't think this is broadly, I'm seeing everyone's doing an AI something across the board on the continent, and it's generally just leveraging agents to do the customer service work for some sort of industry. So I'm quite picky with what makes sense. I don't think everything makes sense. But I do specifically think the use case for fraud detection, cybersecurity, KYC, and truly customer interaction through AI agents, I do think those things make sense to me. In general, I have very strong conviction. I still like unsexy tech. And what that means for me today is trade tech. So all of the initiatives that we're seeing come from PAPS and Afrexim Bank, and even just like the Africa Union, et cetera, to promote Pan-African trade, and to promote and facilitate Pan-African trade. The sort of inter and intra-Africa financial technology or financial services solutions, as well as the movement of goods and services and the tracking of goods and services and the paperwork and compliance side of the trade businesses, that still is totally inefficient, doesn't make sense, and things from Africa to the rest of the world. I've been doing a lot of corridor plays or looking at a lot of corridor plays in the trade tech space. I would say that is what I'm currently most interested in. And then just personally, what I mentioned at the beginning of the call of this burgeoning domestically located, internationally employed African youth. We have a couple companies in our Fund 1 and now Fund 2 that cater to just banking and providing financial services solutions to this growing population. And there's something really interesting there. And the last thing that I haven't seen a real solution for, but I think is a really big problem, and I'd like any founder working on this to come talk to me, is like treasury services for small and medium-sized businesses and individuals across Africa. For example, if you receive a 5 million naira payment and know that you are not going to make another transaction for some period of time, you need to keep this money in your account, and you know that you're going to be subject to inflation, devaluation. How can you hold that in a foreign currency? Or how can, what sort of treasury services shorter term treasury services or hedging services can be offered to small and medium-sized businesses that are holding float for some sort of period of time?
Thank you so much, Mara. Thank you, Sunil. Anil, your thoughts?
In the interest of time, I'll just say, because we come in so early, we're just looking for innovative solutions, whatever that might be. We are sector agnostic. Truly, the way that we look at things is what is going to be relevant a year from now, because it's going to take you a year, or 6 months or whatever to kind of get to that point where this business makes sense. We want African solutions. We want African buyers, somebody that can pay 1,000 naira for your service, multiple by whatever 200 odd million population that we have. That's kind of what we're looking for. And of course, the poultry farmer that can get a chicken to lay 2 eggs instead of 1. I'm still interested in that if anyone has that cracked. That's pretty much it.
Okay. Thank you so much. So we have a question here from the comments. So I'm just going to take that, and I think anybody can take it. Okay, so I'll just pick one person, and then we can bring the session to a close. So the question is, beyond capital, what should founders look for in an investor to ensure long-term growth and mentorship? Beyond capital, what should founders look for in an investor to ensure long-term growth and mentorship? So Neil, do you want to take that?
I guess it's connectivity, network, ability to, make inquiries on the behalf of the company or produce opportunities based on, conversations or meetings that are happening, that were kind of not planned, but just happened in the course of business. And then remembering that for that investor to always, remember this company and be able to make that connection, someone who will in fact write the email or create the WhatsApp group or wherever it is, and then sort of position the opportunity. So you're kind of like a catalyst, a business development connector, that's out there, perhaps in another location, another part of the world, but has that company in mind. And then that's a relationship that can last for many, many years, well after the investment, but just because you're a shareholder and the company and you're somewhere in your thoughts, you can connect and help the company out with some sort of things that lead to growth.
Yeah, thank you. Okay, thank you so much, Sunil, Anil, and Maya. It's been a very wonderful session. And I'm sorry, the network wanted to stop my shine, but I'm not going to. I'm not going to agree. All right, I've had a very wonderful time, and I'm sure from the comments that we've been seeing in the comment section, it's been a very wonderful time for the audience as well. Thank you so much for doing this with us. I have like a load of notes that I have, that I've taken down, but in the interest of time, because I understand that you all are very busy people, so we really appreciate the time that you've spent with us. Thank you, and have a great evening. I don't know if I would say you should just give your closing remarks, maybe like in a minute, just so I don't take the shine. Okay. I see. I can see the shake. So I think it's okay. So I'll just do the remarks on behalf of everybody. Thank you so much. Thank you to our panelists. Thank you to the audience as well. Have a great evening. Bye.
Thank you.
Thank
Bye.
you.
Thank
Bye.
you. Bye.